All right, well, as we await that market open, I do want to welcome my first guest, Kenny Polcari, managing partner at Case Capital Advisors. Kenny, great to see you at the stock exchange this morning.
Thank you. It's a pleasure to be here. For me, it's like coming home after spending 40 years down there in the trading floor.
Yeah, I know. Many happy faces to see you and have your presence here today. Let's talk about this Trump trade. Stock set to open at record highs. What's behind it?
It was an amazing day yesterday after the election results. But to your point, you said it on the intro, right? It's about clarity. Because the market just wants to understand where we're going, right? It remains volatile when it's unclear, but once there's some clarity on the market, good or bad, the market can function. In fact, it responded to the election results in a very positive way yesterday. I think part of that was just relief that it was over and it wasn't stretched out over 4 or 5 days. Like a lot of people, there was a lot of talk that maybe this was going to take days to resolve. In fact, it didn't, and so I think the market was celebrating that fact. I also think the market was now celebrating the fact that this new administration and what to focus on and what is going to benefit and how should investors prepare themselves. But don't forget, it's also a big week. We get the Fed today too.
Right.
It started yesterday, it's today, so that's also playing into market action.
So when I checked the Fed funds futures this morning, 97+% chance that we get a 1/4 percentage point rate cut today. I'm assuming you're part of that camp as well.
So no, actually, I'm not.
Really?
No, because I thought they were very aggressive in September when they cut 50. So I was looking for 325 cuts this fall.
Yep.
September, November, and December.
Yes.
They did 50 in September. So I'm in the camp that they should do nothing this month.
Yep.
And they should wait and see, and then they can play catch up in December if they have to. But the market is expecting a 25 basis point cut. I think that's what it's going to get.
Yes.
Because they went into blackout mode, and then the Wall Street Journal, as they would typically do when the Fed's in blackout mode, comes out with an article, and Nick Timrose came out with the article arguing for that 25 basis point cut and why it's necessary. So I don't think the market's going to be surprised. I think that is exactly what we're going to get.
Right, and we know that the Fed does like to broadcast that, sometimes often through the Wall Street Journal reporter, to make sure that the market can expect it.
Right.
I want to hear from you, Kenny, what you anticipate we might hear, though, from the Fed chair. I'm sure he's going to get questions this afternoon during the press conference about the Fed's independence with the new president set to take office.
That's right, and the Fed should remain independent, right? That's one of the key things between the executive branch and the Fed, that the Fed needs to remain independent. I don't suspect that he's going to say anything other than he remains independent, that he's not going to be swayed by any particular administration, which is true. He should not be. He should really be just focused on what he needs to focus on, the labor market and inflation. So I think what you're going to hear is that inflation is trending lower, which it is. It's not completely resolved yet, but it is trending lower. And then he's going to worry about maybe some weakness in the labor market. And I think that he's going to be able to highlight Friday's weak NFP report as a reason that we need this rate cut, because he wants to make sure the labor market doesn't completely collapse. I don't think it's going to. I think the other data suggests that the labor market is fine, but if he's going to cut by 25 basis points, he needs to be able to couch it in a reason.
Let's talk more about the repositioning that's happening. People looking at their portfolios, maybe adding to small caps, adding to bank shares in the wake of this certainty that we got.
So the banking and some of the other stocks, sectors, are going to be a direct result of less regulation. Small caps is a different argument. Small caps is an argument about lower rates, because small cap companies tend to borrow money to fund their businesses. So if rates go lower rates actually help them, right? The other thing that small caps are typically U.S.-centric companies, right? They create in the U.S., they sell in the U.S., their clients are U.S., is that they won't be affected by any tariffs if, in fact, there are going to be tariffs. I'm not sure they're really going to be tariffs. I think he's using tariffs as a leverage play. I'd be surprised if across the board we see that, but that would be the reason that we see some movement into the small cap names, as well as people anticipate kind of what the administration may or may not impose.
It's interesting because in the wake of these results, the inflation word, the I word, if you will, which has been such a focus since 2022, seemed to come back in focus. What does the Trump administration, potentially a red wave in D.C., mean for inflation?
Well, so inflation is probably going to rear its ugly head again, no matter who was in, whether it was a Democratic administration or a Republican administration, because both have promised to spend more money. So I'm not necessarily thinking that inflation is going to go lower. In fact, I think what's going to happen is that it's going to rear its ugly head, and the Fed is then going to move their target from 2% to either 3 or 3.5%, that they're willing to have inflation run at the 3 or 3.5% level, just because of all this government spending that's going to happen. And that would have happened under either administration. So I think you have to be careful how you couch that, saying, well, it wouldn't have happened under a Democrat. It would have, because they were prepared to spend as much money as well. I'm not arguing one side or the other. I'm just saying, as an investor, you have to assume that we're probably going to see inflation rear its ugly head. Here's the point, though, that you have to be really concerned about. Are they going to be able to control it to the 3.5% level that it's probably going to go to, or are we going to see it spin out of control again the way it did when we saw inflation surge up to 9% in 2022?
So what does this mean for American families, many of whom were frustrated and elected Trump because of that?
That's right. But listen, Trump, from a regulation and taxation side, right, the Republicans will keep taxes lower, maybe even cut taxes. So that would be a benefit to not only to Americans but to investors. But also then try to grow the economy, right? So get the economy growing faster than its 2% annual rate, because then that will also help. It'll help wages. It'll help the economy. It'll help bring down inflation.
Kenny, what else is on your radar as we await this market open?
Oh my God, there's so much on the radar. Really, what today's on the radar is the Fed, and then beyond that's the end of earnings season, right? We got another couple of weeks of earnings season, and we've had an earnings season that's actually been okay. We've got about 80% beat rate, which has been very, very interesting. And then the guidance forward has been mostly robust. So I'm excited to hear more of that in the next 2 weeks.
Kenny Polcari, managing partner at Case Capital Advisors. He's going to be sticking with me after the market open as well. And you're here for Building Homes for Heroes, is that right?
No, I'm actually here for the Headstrong Project, which is another veterans organization. We have a big gala event tonight where we treat veterans that suffer from PTS.
Yes.
It's interesting that you guys have this happening today. I think it's great around Veterans Day that we're focused on veterans.
Leading into Monday. We're so happy to have you, Kenny. Thank you. He'll be with us throughout the show, but after the break, we'll take a closer look at what changes could be coming for big technology as Donald Trump is elected 47th President of the United States. And of course, as we see stocks across the board really benefit in today's session, I do want to bring back Kenny Polcari. He's a chief market strategist at SlateStone Wealth. Kenny, great to have you back in studio, and great to celebrate the veterans as well.
It really is. It's, with the holiday coming up on Monday, this project is actually a great veterans organization. I'm also here for another one, which is a great organization. So it's all very exciting.
Yeah. So let's talk about stocks here. Of course, opening at all-time highs. We talked a bit about the sector rotation, but I do see technology names leading the pack today with fractional gains across the board. Yeah,
so I'm not surprised by that. Look, technology, it all participated yesterday. I think the Dow actually was up more broadly than the rest of the market. The Dow's been underperforming the broader market, right? The S&P and the NASDAQ are both up 20+%. I think the Dow is up 15 or 16%. So that was just a little bit of catch up. But I think it's exciting, and I think we're seeing this money continue to move into AI. We saw great results from Palantir the other day.
Yes.
And then Palantir's forecast was actually really what drove the action across a range of tech stocks within the sector. So it's not surprising at all. I think tech is going to continue to play a major role in this revolution that we're in. So it makes perfect sense.
What do you want to hear from the Fed Chair Jerome Powell later today after the decision?
So I want to hear that that he's going to tell us that the labor market is resolving itself, that it's not as weak as maybe he thought it was in September, that he's got that under control, that while they expect inflation to rear its ugly head again, as we discussed earlier, that he doesn't expect it by any means to spin out of control, because he expects if the economy grows at the way the new administration suggests it might, is that we should be able to control it, right, and have a healthy economy without having exploding prices. And so I'm looking for some guidance from the Fed chair about that and what he thinks the future looks like.
Is there anything that he might say that you think could move stocks off the path that they are on, knowing that the Fed is independent of the balance of power in D.C.?
Yeah, I think he could suggest that he sees the labor market weakening and that he's fearful of a recession, which would be negative for stocks. That would be what I think he would say that would knock it off its track right now. I don't think he's going to say that. I think what he's going to say is that the economy remains strong, and he continues to see it remain strong. Like I said, I think it's all going to hinge on what he says about the labor market in terms of kind of how investors interpret what that next move is. I think he's going to leave the door open for further rate cuts. I don't think he's going to commit, though, to anything specific in terms of every meeting they're going to cut 25. I think he's going to say it's all data dependent.
Yes.
He's going to leave the door open, but he's not going to commit.
What does this decision and the impact of the election mean for the bond market?
Well, so I think the bond market's telling you a couple of things. Because look, he cut rates by 50 basis points in September, and the bond market has done nothing. Yields have done nothing but go up. Bond prices have gone down and yields have gone up, which is really counterintuitive to what you think might happen. But I think what the bond market is telling us is that it also expects the inflation to kind of rear its ugly head again. Again, muted, not out of control, but that the bond market is expecting that we'll see that with all this government spending that's been promised to spend, is that we'll see that happen. And so I think the bond market is just telling you to be a little bit cautious in terms of being so excited about plowing money into stocks. But look, remember, bond prices and yields have an inverse relationship. As investors sell bonds, yields go up. And so I think part of what you saw yesterday was bond investors were actually selling bonds to plow money into stocks under this new, what's perceived as this new administration and what it's going to mean for the economy. And so that's kind of where we saw a big spike in bond yields yesterday. But I think you just have to watch, where's the line in bonds? Is it 5%? Is that where it's going to find, the market's going to find to struggle a little bit? If bond yields get to be closer to 5%, I think it will.
Does Bitcoin look attractive to you in this environment?
Bitcoin looks very attractive. Certainly, again, under a Trump administration, it would be less regulation. He's very positive on crypto and blockchain, and so therefore we saw what happened to Bitcoin yesterday. I think it's actually up again today. And so yes, I think Bitcoin is attractive, but I think as an investor, you have to be careful. You have to look at it, understand its risks, and not necessarily let it become too big a percentage of your portfolio, just as you wouldn't with anything. So I think investors need to kind of be in it. I think you need to be in it depending on where you are in the life cycle is going to dictate how much you're really in it.
I see this is the best post-election rally ever. We've talked about deregulation. We've talked about lower tax rates. I want to talk more about domestic growth. We mentioned the small caps earlier, but what this outcome means for smaller companies and growth here in America.
Well, so if the U.S. economy starts to grow better than the 2.8%, if it does what they suggest it's going to do, then small and mid-cap companies, which are really U.S.-centric, right? They manufacture, they sell here, their clients here. They're not dependent on what happens around the world. That they will certainly do better. And we've seen that over the last couple of weeks. We've seen money move into small and mid caps. They had been underperforming all year. Now they're starting to play catch up because investors are considering that these are going to be undervalued names that are going to do well in this new administration, especially if we see rates tick down a little bit. Like I said in the other broadcast, that lower rates will help small and mid cap companies as well as a stronger economy.
Kenny, I know many people are happy to see you here at the Stock Exchange today. Thank you so much for making time to join us on the show.
Thank you for having me. I'm happy to come back.
Okay, great. We look forward to that. Kenny, of course, is a chief market strategist at SlateStone Wealth, and we'll see you soon.
Thank you.